Hey guys, Rahul Shah here, trying to make investing accessible and profitable for the average investor. The year 2020. Now, the year 2020 has indeed taught us a lot of things, but I think one of the most important lessons that I'm going to take away from this year, from this interesting as well as shocking year, is that stock market predictions do not count. If anyone tries to make a stock market prediction, if anyone tries to tell you, if anyone is trying to be too cocky and making a prediction about what the stock market is going to do over the next 12, 15 months, 18 months, I think you should take all such predictions with a pinch of salt. In fact, not just pinch of salt, but take it with a fistful of salt, because stock market is too complex a beast to be predicted, to to make a prediction. uh, it's virtually impossible. And 2020, I think it's a wonderful example of that, of how no one, absolutely no one, has any idea of what the stock market is going to do over the next 12, 15, 18 months. I mean, at the start of the year, who would have thought that stock market is going to collapse to a multi-year low, and within a few months it's going to undergo such a sharp recovery that it will touch all-time highs. In my career, at least, I have not seen a year as interesting and as shocking as 2020. I have not seen a year where within 12 months the stock market has touched a multi-year low and has gone on to achieve all-time highs. So for quite some time now, for quite some years now, I have been of the belief that stock market predictions do not count, irrespective of the guru that predictions are coming from, irrespective of the analysis, irrespective of the research, irrespective of the computing power that has gone into making stock market predictions. You should not believe in predictions at all. Stock market predictions you know are just simply, uh, they need to be ignored. Now this presents an interesting conundrum. This presents an interesting puzzle, because investing is all about the future, right? You are investing right now to make certain returns in the future, which means that future plays an important role in stock market investments. And if I'm saying that you cannot make a prediction of the stock market future, then how do we resolve this dilemma? Because you have to invest taking the future into account, and at the same time I'm telling you that you should not make stock market predictions. So how do you reconcile these two contrasting statements? I think I'll take the help of Warren Buffett in resolving this dilemma. Warren Buffett's one of the most one of my favorite Warren Buffett quotes is that predicting rain does not count, building ark does. Or that was of course the biblical version of that. In If I were to put this statement in simple terms, it would be that don't predict how strong, or where the winds would blow. Try to build a very strong boat. Now what I mean by this is that you should not predict the future. Instead, you should try and protect yourself from the future. You should try and build such a strong boat that no matter how strong the winds blow, your boat is safe and you are able to survive. Let us try and understand this with the help of a chart that is there on your screen right now. This is an interesting chart because it shows the stock market valuations, the broader stock market valuation that the Sensex has traded at over the last 20 years. Now I have taken data since December 2000, because I believe that the December 2000 onwards, the Indian stock market had started becoming more efficient. There was information available to everyone, corporate governance improved, FIS started taking a keener interest into the Indian stock market in the 21st century. So the Indian stock market post 2000 was a more efficient version of the market, and therefore I've taken data starting from Jan 2001. Now this is the PE that the Sensex has traded at, each trading day since January 2001. So, the different P's that the Sensex has traded at for each trading day since between January 2001 and December 20. Now, the average PE of the Sensex has been 20 times. So, which means that if you would have invested in the Sensex at a PE of 20 or below, it would have been a good time to invest in the Sensex, and your returns from a 2 to 3 year perspective would have looked quite good. Now, consider those two circles that I have marked, the peaks that I have marked. One, between December 2005 and December 2010, and another one between December 15 and December 20. Now, the first one, the December 5 to December 10, that circle, that peak coincides to the subprime crisis. And you take a look at the Sensex PE back then. I think the Sensex PE was trading at a price to earnings multiple of around 27, 28 times back in January 2008 when the Sensex peaked and we had that subprime crash, huge crash. Again, when the markets collapsed on account of the coronavirus pandemic back in March 2020, the Sensex had again reached a high of 26, 27 times, and then it collapsed from there. Now, one of the conclusions that can be drawn from this particular chart is that if the Sensex multiple is in the region of 27, 28 times, it is not a good time to invest in the Indian stock market. If the Sensex is trading at a price to earnings multiple of 26, 27, 28 times, there is a chance that the returns from a 12-month to 15-month perspective could be poor. There could even be a crash as we saw in December 2008 and we saw in March 2020. So, a good conclusion could be that whenever the Sensex has touched a price to earnings multiple of 26 or more, it will be a good idea to take some money off the table, move out of stocks, and get into the comfort of cash or fixed deposits. Now, over the last few years, I have come to believe that if you have a corpus of rupees 100, you should set aside 25 rupees and invest that in stocks, and you should also set aside another 25 rupees and invest that in fixed deposits. So at any given point in time, you should have at least 25% of your money in fixed deposits and at least 25% of your money in stocks. Now, irrespective of how cheap or how attractive the market is, you should never move that 25% that you allocate to fixed deposits into stocks, and irrespective of how expensive the market is, you should never be fully out of stocks and have that 25% stock element, move that into fixed deposits. So at any given point in time, the minimum in cash should be 25% and the minimum in stock should be 25%. For the remaining 50 rupees, you can move that in and out of stocks based on the broader stock market valuation. Now, a good idea back in Jan 2008, when the Sensex had touched a PE of 27 times, would have been to either be 50% in stocks or be 25% in stocks. Again, a good idea back in Jan Feb to 2020 would have been to be 25% in stocks or 50% in stocks and have the bulk of your investments in cash and fixed deposits, and likewise in Jan 2020. Now, a lot of people would say that this looks good in hindsight. It's all very good to say that the Sensex collapses when the price to earnings goes up more than 25, 26 times, and usually timing the market is not that great an idea, and you should always be 100% invested in stocks because you cannot time the market. Now, this would be true. I have no objection to this. I think if you don't want to time the market, if you do not want to take a valuation bet on the broader market, you can be 100% in stocks. You can be 100% in stocks all the time. But I'm of the view that if you are 100% in stocks all the time, you are the market, you are behaving like the general market, and therefore it is that much more difficult for you to beat yourself. If you are in stocks all the time, if you are in stocks 100% of the time, uh, it is very difficult for a 30, 25, 30 stock portfolio to outperform the market, because your portfolio will consist of stocks which have the best growth prospects, which are the which are the best in quality. It will be mostly consisting of blue chip stocks. And if you think that your portfolio is attractive, the market also thinks so, and therefore the portfolio will be more or less, adequately priced. It will be very difficult for you to outperform the stock market if you are in the stock market all the time and you're behaving like the general market. On the other hand, if you have to outperform the market, if you have to, earn those 20-22% returns per year, uh, uh, which is higher than the 14-15% the stock market has given over the past couple of decades or even more. If you have to earn those 20-22%, then you'll have to behave differently from the market. You'll have to go in the opposite direction of the crowd. You'll have to be fearful when the market is greedy, and greedy when the market is fearful. So back in Feb 2020, the market was very greedy. It was a good idea to be fearful and be have some of your money in fixed deposits or cash. And in March, April 2020, when the market had turned fearful, it was a fantastic idea to be greedy and allocate some of the money out of fixed deposits and bonds and into stocks. So there are two things here. If you want to be 100% invested in the stock market, by all means be 100% invested in the stock market. You will, I think, still earn the returns of the broader market. You'll still earn 14-15% from a long-term perspective. It will be difficult for you to earn 20-22% if you are 100% invested in the markets at all. I'm not saying it's impossible, but it's difficult. On the other hand, if you keep moving in and out of stock markets based on valuations, because the markets also fluctuate, they have the habit of being overvalued and then being undervalued. And if you try and develop a system where you're able to take advantage of these overvaluation, undervaluation, and you're doing things opposite to that of the crowd, and you're being fearful when the market is greedy, and greedy when the market is fearful, that approach, I think, is more likely to give you market beating returns over the long term. So if you have to, uh, if you have a goal of trying to outperform the market over the long term and earn those 20-22% returns, then you'll have to do things differently than the crowd. You'll have to keep switching your money between stocks and bonds and take advantage of the underlying undervaluation and overvaluation. Of course, it's no guarantee that by doing this, you can beat the market. Uh, but that way, I think you stand a better chance of doing better than the market than being, say, 100% invested. So my prediction for 2021 is that do not try to predict the market. Uh, you know, Shift your money between stocks and bonds based on the undervaluation, the overvaluation. And as things stand right now, I think the markets are in the overvalued zone right now. The Sensex PE is in the region of 32, 33, times, which is, I think, very expensive. And even if you account for the fact that the earnings of the Sensex are depressed earnings because we've had a couple of very bad quarters. They are not normalized earnings, and if you normalize them for a normal business environment, even then I think the Sensex is slightly overvalued. So, my advice at the current juncture would be to at least be 50% in cash and 50% in stocks, if not 25% stocks and 75% cash. I don't think this is a market where you can be in 75% stocks and be only 25% cash. There was a time to do so, and it was in back in March, April 2020, when the Sensex PE had fallen to 17, 18 times. That was a good time to be 75% in stocks and 25% in cash. Right now, I think it will be a good idea to book some profits, take some money off the table, and reduce the allocation to, say, 50-50 and 25-75, where 25% is stocks and 75% bonds. So that's my suggestion for 2021. What do you think of this idea? Do let me know in the comment section. And if you like the video, please do not hesitate to press the like button. Your encouragement means a great deal to us. So that's all from my side today. I'll see you again next time. Thank you so much.